we almost have the media advertising for us in the mortgage industry. And there's one thing that's talked about a lot, and that's the Federal Reserve. And I don't know if we necessarily know why or what the Federal Reserve is and the role that it has on mortgage-backed securities and mortgage interest rates to the customer. So I found this on Wikipedia, and I just want to read this for a second, put it up here, and then I just want to break down what I think the Federal Reserve is and why you need to know about it. So the Federal Reserve, also known as the Fed, is a central banking system for the United States of America. It was created in December of 1913 with an enactment of the Federal Reserve Act. After a series of financial panics, this was basically created to protect the United States. This is super interesting. I think it's important here. So let's go back to this. This is the definition, like the three key objectives of the Federal Reserve. The U.S. Congress established three key objectives for monetary policy in the Federal Reserve Act: maximizing employment, stabilizing pricing. So stabilizing pricing is related to inflation, right? So that's making sure that the cost of goods and services don't get too expensive too quick, and moderating long-term interest rates. So what are long-term interest rates? That's mortgages. So moderating long-term interest rates. So their role, the three key objectives, is actually manipulating mortgage interest rates, making sure the economy doesn't get too hot and goods and services don't become too expensive, and maximizing employment, making sure there's jobs, making sure there's opportunity for businesses to hire, making money easily accessible so that businesses can grow and hire people. Okay, why is it important? Well, the reason I'm bringing this up today is the Federal Reserve just announced that they're potentially going to be easing one of those three key objectives, and that's related to long-term rates. So the Federal Reserve has been doing is buying in billions of dollars mortgages on the secondary market. So if somebody really wants to buy something, it becomes more valuable. So if you have something like the Federal Reserve buying mortgages in the massive amount that they have, it makes them more valuable, which, and there's a long explanation of this, but which has decreased mortgages to the consumer. So if the Federal Reserve is indicating that they're potentially going to ease the purchasing of those mortgages, what happens to rates? They go up. So we have seen a very long-term low interest rate environment. And so now I think there's an opportunity with a statement like this that just came out from Jerome Powell, the Federal Reserve president, indicates this right here. The Fed edged towards reversing its easing policies, but it may move slower than some expect. So really good news. They're saying that they're potentially going to decrease the amount that they're going to buy, but they're not going to do it rapidly, and they're giving the market an opportunity to not react emotionally, which is good. So don't react emotionally, but if you've thought about doing a refinance, now might be the opportunity, because if they back off on their purchasing of mortgage-backed securities and mortgages, interest rates have to go up. They have to, because this entity that's buying billions and billions and billions of dollars of these mortgages, forcing interest rates down, may be potentially stopping. I hope that helps. Have a blessed day. Keith Collins, Moving Mortgage. Take care, y'all.